Good morning, everyone. It is half an hour before the market is going to open on December 31st, 2024, the very last day of the year. So, happy New Year's Eve, everyone. I hope you guys have an amazing day and amazing year ahead of you. Now, it's been a little while since we've done a pre market or even a post market review. So, I figured, hey, end of the year, let's take a look at what happened in the markets this year and what we can expect going forward into the next year, especially in the first couple of weeks. So let's go ahead and take a look at our S&P 500. It was a huge year this year, a very rare year where the S&P was up about 25%. If we take a ruler here and take a look at where we started versus where we ended, we see that we're right around 25%, 24%. I didn't draw exactly at the open of the new year or exactly at the close of yesterday, but it's pretty close to 25%, which is pretty amazing for an index that normally averages around 6 to 7%. So you can see that from this chart, we're on an amazing bull trend over here. But what we're starting to see for the first time actually is see, so this is a high, this is a low, there's a higher high, a higher low, a higher high. Then over here, we did have a correction where we had a lower low, a lower high, a lower low, but we had a really strong bounce off of that where we had an equal high, then an equal low, or maybe slightly higher low. Then we are continued the uptrend, higher high, higher low, higher high, equal low, higher high, higher low, higher high, and then what is this? Right at the end of the year, we had a little bit of a stumble where we got a lower low, lower than this one, and a lower high, lower than this one. And now we're headed back downwards. So what we want to see is this another pullback correction, just like this over here was, or is it going to become a break of trend? That is a little bit worrisome. The major difference between now and then was this was the August correction, which was just a natural rhythm and flow of the markets. Nothing had really changed hugely or fundamentally in the markets. What changed over here is September. Over here in September, we had a huge rate cut by the Fed over here, September. That gave us a huge stimulus that pumped us up to December. And then in December, the Fed goes, oops, well, we may have cut a little too quickly. And we, instead of projecting 6 rate cuts for 2025, now we're only going to project 1. And that pulled a lot of steam out of the markets. We had that big 1 day move, the biggest of the year. And we tried to bounce from that, but we have since dropped. So the Fed changing its tune, changing its mind, not really quite admitting that it messed up, but slowing down its pace of rate cutting or its projected pace of rate cutting has really pulled the steam out of markets. And really, what should happen is that they shouldn't even stimulate at all. They should really go back to rate hikes. But of course, that would ruin the market and ruin sentiment across the nation and across the world. So they're very, very unlikely to do that because what they're looking for is orderly markets. So they can only pull back so much, or they can only draw back on what they've done so much before we get panicked markets, before we get gaps and giant drawdowns, single day moves. And the Fed doesn't really like that at all. For example, back in 2020, when we had the pandemic over here, this was very disorderly. The first couple of weeks was hugely disorderly. And then the Fed came in and they cut interest rates basically to zero. So they don't like it when markets start gapping and having huge bars. And that is why they are not going to just completely stop their rate cuts and start hiking rates. They need to do that in stages and slowly. So in any case, this is a fundamental difference. This is the major difference between this August pullback or correction and what we're starting to see right now. Now, we had the Santa Claus effect. We still have optimism in the markets. We still had money that was being put to use by fund managers towards the end of the year in order to get their assets under management up, or at least out of cash and into actual assets under management. And so that's been propping up the markets. That's probably going to go away in January. Once we get back from vacation, so we have the weird oddball vacation this week, tomorrow. So markets are going to be closed tomorrow. We had a weird oddball in the middle of the week for Christmas or winter holiday. And then we had the same thing every year on Thanksgiving. So we've had this really choppy environment and very low volatility, low volume environment ever since that Thanksgiving week. We've just sort of been drifting. We drifted a little higher, but if we draw a box around that Thanksgiving week until now, you can see that we basically stayed inside this box right here. So the markets, yeah, they drifted up and then they came down and drifted, but they ended up going nowhere from the Thanksgiving week all the way until the end of the year. So there's just been one giant chop fest, a big range chop fest, but big chop fest ever since Thanksgiving. So it's been a difficult market with thinner participation than we normally see, even for a holiday. So what that means is, we couldn't really go anywhere in the last month or so of the markets. And now, after hedge fund managers get their bonuses, then they're going to need to have cash available. Otherwise, they can't invest in anything else. So unless everything that they're invested in right now is just going to keep on booming and keep on going up, fund managers need to cut their losers, cut the underperformers, and take that cash and then reallocate that cash and put it into something else. The first part of that process is liquidation, and that starts today. Today is the last day for tax lot selling, and we are probably going to see some of that happen. Even though the futures tell us we're slightly up this morning, what we're going to see is all the weaker names are probably going to start selling off today. So let's take a look at what our sectors look like and see if we can get a clue, at least at the sector level, as to which stocks might be selling off a little bit today to make room for portfolios and cash so we can invest it in the beginning of 2025. Now, remember, we're not expecting a lot of volume this week because of the holiday, and then normally it takes a few days in order for us to resume normal operations. So normally we would expect the last half of next week to be really when fund managers start coming back in and start putting money to work. However, we also had the passing of former President Carter and the announcement that markets will be closed January 9th. So that is next Thursday. I don't know why they picked Thursday. I don't know why they couldn't have done it on Friday or Monday, but they picked Thursday. So they're chopping up our trading week again. So it's going to be another unusual, weird week next week. So most likely we're not going to see a resumption of normal markets until January 13th. And let's see here. Monday, Tuesday, Wednesday, Thursday, Friday. That's fine. Tuesday, Wednesday, Thursday, Friday. You see that? We've got another holiday on January 20th. So all of January is really chopped up. It's going to be very difficult for the markets to get a leg. It's not impossible, but it's going to be more difficult for markets to really be able to resume normal operation. And all of that means probably a continuation of this choppiness going through January. And if we get a downgrade in sentiment where people start losing confidence and they start wanting feeling unsafe, and they're wanting to uh, go more into cash or safer assets rather than a risky asset, then we may see money move out of the markets, and that would start off 2025 to a little bit of a rocky start. There's also some risk of recession. It's not imminent, it's not huge at this moment, but it is possible in 2025, even more possible in 2026. So those are all things that we're going to look at in the longer term in 2025. But for now, just looking at January, or just because there's so many of these chopped up weeks happening in January, almost all the weeks. There's this week, there's next week, there's the not the week after that, but the following week after that, another vacation week, not one that's chopped right in the middle, but at least a vacation week. That's going to make it hard for real volume and to come into the markets. So I'm expecting a lot more chop and perhaps a little bit of a downward movement. Also, what we see here is that yesterday we broke back down below the MA50. We came down below the MA50 near the EMA 100 and bounced back up to a lower high, and we moved back down below the MA50 and in fact below the quarterly VWAP, and we're floating here. That MA50 is going to start to become resistance, same as the EMA 20. So it's going to be critical if we're going to continue to move upwards to move back up above those moving averages. And right now, I don't know, with the chopped up week this week and the chopped up week next week, I don't know if we have the firepower or the catalyst to get back up there. And the longer we stay below it, the longer we have a unoptimistic outlook for the markets, and the more difficult it is to get that sentiment back up, and the more likely it is that we start heading a little bit lower instead of resuming higher. Now, in the normal SPY, we still have quite a distance to that MA 200. So we won't technically go into a bear market until we go below that MA 200, but there is this possibility of heading down towards it, and then that would be a correction right off the bat, right at the beginning of 2025. We'll see if that happens, but right now, the first hurdle is to get back above that MA50. But again, January, even if we get above that MA50, are we going to make a new high? It's going to be difficult because of all those chopped up weeks. So now that we've taken a look at that, let's take a look at what was I going to look at? Could look at bonds and all the rest of it, but there was something else I wanted to look at in the S&P 500. My apologies, I'm blinking right here. There's something that as I was speaking that came up as important to note. Oh, yes. Let's look at the equal weighted. So we're below the MA50 on the normal SPY. I want to see how close to the MA200 we are on the equal weighted. So RSP, you can see that we're well below. Once we broke down below that MA50 that first time, we never recovered back up, unlike the regular S&P 500. What happened was we recovered to the EMA 8 and rejected and bounced right back down to this MA 150. So we're getting kind of close to that MA 200. That's not great news. So fundamental under the structure of the markets, it's looking weak. It's looking weak. So we're really going to want to see this MA 200 hold up for the RSP. Let's take a look at QQQ. QQQ is still above the MA 50. It never went below it. So bounced, went up, came back down to re-challenge this MA 50. So definitely tech and discretionary is doing much better than the overall markets. And let's look at that equal weighted QQQ. Equal weighted QQQ is telling a very different story than the normal QQQ. We are bounced well below that MA50, back up to the EMA8 and quarterly VWAP, and then gapped down and gapped down again yesterday to that low, almost challenged that MA200. So it's really looking, equal weighted is really looking weak. So that means that it's been the Magnificent Seven that has propped up not only the QQQ, but the S&P 500. So if any of the Magnificent Seven or all of the Magnificent Seven fail, then this market is really in trouble unless the Magnificent Seven can hang on and long enough that a broad basket of sectors and basket of stocks can move upwards, then we could see some shakiness inside these markets. We could see this QQQE break below that MA200, and then once the Mag 7s falter, then the whole entire market just plops down. Now, we'll see. Maybe the Magnificent Seven can hang on a little longer in time for other stocks to come upwards. But really, why did the Mag 7s go up? And where did they really start moving up? Is over here back at the election. After the election, we drifted sideways, and then after Thanksgiving, that's where we really moved upwards. We saw this huge movement upwards into the middle of December, and then some chops sideways. So that means that in that entire time, we saw that chops sideways for the S&P 500. Money was moving into the Magnificent Sevens. Why? Because fund managers are trying to get their assets under management up so that they can pad their bonuses, basically, to put it bluntly. They're padding their bonuses, they're padding their performance, and they need to find something that could return higher than the S&P 500 if they need to catch up, because when the S&P 500 is up 25%, well, that's not easy to match when you're trading discretionarily. So if they want to beat the S&P 500 and earn their bonus, or at least get a larger bonus, then they need to outperform that 25% for the year. The easiest way to do that, if you need to play catch up and there's only 1 month to go, is to go into the biggest market cap and strongest stocks at the time, and to try to outperform that S&P 500. And for sure, that Mag 7 during this period did outperform the S&P 500. So that is a quick and easy, dirty way to boost up your end of year performance and get assets allocated, or get cash allocated to assets and out of cash, so that you have more assets under management, excluding cash. So that's why we have this run up. Now, the question is, when we get to the new year and fund managers need to free up cash, and they're no longer going to cut their losers because there's no tax advantage, there's no incentive for them to cut those losers. They would have cut them already before today, or today and before. So if we're into new year and you need to free up even more cash, what are you going to do? You're going to sell off your top performers, because one, that frees up more cash, but number two, your expectation is a mean reversion. So if we had a huge gain from something, well, you want to sell that before that something pulls back. And so the mags could become a target for some selling in the beginning of 2025. And if that's the case, then we're looking at a dangerous scenario for the S&P 500 and for the overall markets, the QQQ. We already looked at the QQQE and the RSP. So if we then look at the Dow Jones, right, the Dow Jones is looking more like the equal weighted indices that we just looked at, except it's more like the RSP and less like the QQQE, because we are further away from that MA200. However, the RSP was in worse condition also, because it was closer to this MA150. In any case, the pattern, their overall movement and pattern looks very similar. And this is definitely a lower low and definitely a lower high into a whole bunch of resistance. And now that we've gapped down to kind of get close or match these lows over here, well, we're looking at a bunch of resistance overhead, the EMA 100, the EMA 8, the EMA 20, the MA 50, and the quarterly VWAP. That's a lot of resistance above. And finally, let's look at IWM, our small cap stocks. It's looking almost basically the exact same as the RSP. So it's the exact same pattern. These charts look exactly alike, except for you might have shifted. So look at IWM, look at how this looks, okay, and its relation to moving average. Look at the Dow Jones. See that same high curve downward, tiny little bounce, and then matching that low right there. The RSP, same thing, and then the QQQE. All the same thing, same movement, same pattern. So we're in a little bit of a danger zone. I'm not super optimistic for January. I do think there is a possibility of us continuing to chop sideways because of everything I outlined about those choppy weeks with the weird vacation days in middle or holidays or whatever, days off. The markets are closed on these weird days all throughout January. So that could help us stay choppy. But there is still the more distinct possibility of moving downwards or finding a lower low. So the question will then become, if that happens, is it just a correction right at the beginning of the year? Or does that actually devolve into a bear market and bearish sentiment? There's a lot of other risk factors. For example, credit cards are maxed out. There's not a lot of personal credit left inside of these markets. And that is going to cause spending to go down, consumer spending to go down. So there are a lot of warning signs to be aware of. So that means we want to be careful in our allocation. We don't want to go gung-ho. We don't want to go crazy. This is not going to be like 2024. I can tell you that with confidence. 2025 is not going to be like 2024. It's not going to be this huge trend upwards all throughout the entire year. That I can say with extreme confidence. Of course, I can't guarantee that, and I can't say it's 100%, but the chances of us having a year that looks like 2024 and 2025 are exceedingly low because, first off, it looks like we're going to chop sideways. There's risk of moving downwards or correction right at the beginning. We could bounce up and recover after that, but we'll have to see. So, I've been talking for a while. There's a lot more we can go into. We didn't even look at the sectors like I said we were going to. We didn't look at bonds. We didn't look at dollars. We didn't look at this. I already said sectors. What else do we normally look at? Oh, we didn't look at earnings. We didn't look at the upcoming announcements. We didn't look at what in detail or more detail what the bond market is pricing in for their expectations for the Fed. We didn't look at momentum levels. We didn't look at the internal momentum levels of each individual sector. There's a lot more for us to look at, but the picture that is already developing is that, hey, choppiness ahead, risk to the downside ahead, and everything else that we look at is even if it paints a rosy picture and says, oh, everything's great, then these are still warning signs, early warning signs in the market. If they support everything that we've already seen so far, then it's like, oh, we really need to be careful here. So the moral of the story is going into 2025, I'm going to be very careful with my portfolios and my allocations. We're going to see a lot more puts than we did in 2024. So we're not going to be heavily betting to the upside. We are going to see a lot more balance, some puts, some calls, some puts, some calls. So we're either going to have that balanced approach, or when we start to see a little bit more threat to the markets moving downwards, then we might be more put centric or more put focused. So just be nimble, be on your toes, be careful. Don't go gung ho. Don't say, "Hey, this market is going to rise forever." And I don't want to be one of those doomsdays guys. I'm definitely not saying that we're going into a bear market or a bear crash or anything like that. I'm just saying that in January, it's going to be difficult to make a higher high. It's going to be likely a lot of chopping sideways, and there is a risk of a pullback or correction to that or near that MA200. And then we'll have to see from there. If we do get to that point, then we'll have to see and reevaluate from there. Okay. So have a wonderful New Year's Eve. Happy New Year's Eve to everyone. Have a wonderful, beautiful celebration. Be safe. And I will see you in the new year when the markets open back up on January 2nd. And let's have an amazing and prosperous 2025 together.